Friends, one of our last sessions of the entire seminar. Take a deep breath. We're going back under. Grab a Diet Coke, grab a coffee. Full attention here. We're going to focus on risk, reward, and win rate. So this is going to tie together strategy, back testing, risk management. I mean, basically everything we've spoken about over the last day and a half, 2 days, is now going to come together for you here. Yep. So if you need to chat, head out in the hallway. Otherwise,
What's going on, everybody? I know it's end of the day. Let's go. You know, we saved the best for last year.
Absolutely.
No, honestly, this has been awesome. I know we're coming to the end here. I'm so grateful to be up here with all you guys before I yap about myself and win rate and risk reward. Give yourself a hand. Like, everybody, you guys are awesome. You all deserve a round of applause. All the questions, the conversations, this feels like a mastermind with a ton of great traders, because it is. It's really awesome. So let's jump right into it. Risk reward or win rate, what matters most? Before we get there, a little bit about me. This is like the Mom I Made It slide. You can see a whole bunch of highlight reels, Top Step TV, Boris Schlalsberg, obviously right here in Tampa with you guys. We know this guy over here. But outside of just bragging about myself, I'll tell you who I'm not. Not the best trader in the world. I don't have it all figured out. I definitely don't claim to. Probably not the best trader in this room. I'm sure one of you sitting here outside of all of us is. But what I do bring is 6 years of experience in the markets to a spot where I'm now taking payouts every month, multiple payouts per month this year, which is pretty sweet. Hope to continue that with Top One. No payout from Top One just yet, but we're working on that. But I don't have any numbers up here because I like to let my trading talk for me. If this skips, let's do it. Oh, I went too far. I went back 3. Okay, one more. There we go. Because I trade live on YouTube, 100% free almost every damn day. 9:30 a.m. You can watch the wins, losses, break-evens. You can watch me make mistakes. You can watch me do well. I love to do it, not behind a paywall. It's really fun to do. And I hope to have some of you guys on there hanging out on Monday for NYSE Open. I'm happy to answer questions. I talk with the chat. It's great. But you can decide for yourself whether you want to fade me, listen to me, if I'm worth a damn. All of that fun stuff. So that's my track record. I enjoy doing it there on YouTube. Hope to see you guys on Monday next week. So we'll jump into these next 3 slides and a little bit of the mindset psychology stuff before we jump into the boring math. I know this thing's trying. There we go. Is it going to skip too? Okay, so I was born and raised racing motocross, but before I even get into it, who knows the story of the 4-minute mile? The Roger Bannister story. Okay, bunch of you guys. I'm going to tell you my 4-minute mile story real quick. I was racing motocross since the time I was 3.5 years old. 3.5 years old. Every year consistently up until that picture there when I won my first race. About the time that I was 3 years from this picture, I was ready to win. I had everything dialed in. Great bike, my father as my coach, great nutrition. I was training, focusing, riding like multiple times a week. I was upstate New York, supporting it through college. But every time I showed up, every weekend I was going racing, I would be second, third place. I was right there. Sometimes I would even get the whole shot. I'd be first to the corner, and I would end up right behind first. I couldn't put my finger on why. And it wasn't until I won that first race did I recognize what was going on. Nothing changed when I finally made that decision that day, and I remember it, where I was so angry and mad that I had been, something shifted right there. I was so angry and mad that I had been in second place for so long, and I said, today's the day that I'm going to win. And then I went and won, which was cool. But what happened right after was just absolutely insane. I continued to win. I won every other race that I went to for like the next dozen races. Nothing changed except I won that single race. And I didn't recognize it at the time, but it was the 4-minute mile story. I didn't know that I was holding myself back. I didn't believe that I could win, even though I had all of the skill set. I had the machinery to do it. I had the will. I just didn't believe in myself. And because I didn't believe I could win, I never won. Second place every single time. And then once I crossed that line, and it took me way too long, and I could have done it a whole lot earlier, I had the belief in myself, and I showed up confident. I'd whole shot and run away with it. It was such a drastic change. My father even said it to me, "What changed, man?" And that was it. So I encourage for you guys to try to take away from this. In trading, we are faced with this really difficult challenge. We know how hard trading is, and it starts to get to a point where you learn technical analysis, you learn risk management, you take one of these guys' strategies, and you fight some of the demons inside, and you kind of understand, you're able to control emotions, but you have to believe that you have the ability, without a shadow of doubt, to extract money from the markets, or you won't. And the market won't give you that winner's mindset. Motocross, years, it didn't give me that winner's mindset. I had to make it that day. So I encourage you guys, think on that, reflect on that. I don't have the easy answer on how to just flip the script and give yourself the winner's mindset, but recognize the market's not going to give it to you. If you're waiting for it, it's not going to happen. And unless you believe you're ready to take prop firm payouts to hit whatever goal that you are, striving for, you won't hit it. You physically cannot. So, winner's mindset and belief in yourself. Don't hold yourself back. Running. I've ran quite a few races. This is me at New York, Town of Celebration Marathon, ultra running. That's a 50-mile race. What I take away from running is grit. Doing something really hard every day. Now, you don't have to be an absolute psychopath. I'm not a great runner, by the way. Here's me in New York. I wanted to run a 4-hour marathon, a sub 4-hour marathon. I blew up. It was the second hottest day ever, the year that I ran it. I blew up and I ran like a 4:45. I was walking in the middle of the race. It absolutely sucked. I fundraised. It was autism awareness. Everyone knew I was running it. I was so disappointed. I wanted to quit that race specifically. I finished it, and then I said, I'm going to keep training, and I'm going to hit that 4-hour marathon no matter what. If I blow up at the next one and the next one and the next one, I'll continue to do so. And that's the grit. Just never stopping from whatever that goal is. One foot in front of the other, continuing to hit your goals. And that's what I did, Town of Celebration. That race was super gnarly. It was a 50-mile race this year. I ran it with my brother-in-law. At mile 30, I had a gnarly headache, super gnarly headache, probably from the long-ass hair that I've cut off recently, bouncing around. My knees were absolutely killing me. My legs were swelling up. And I sat down at mile 30. I was like, dude, you got to go. He was a better runner than me. He's on his way to a 100-mile race. I was like, you got to go. And he left. I sat there. It was a 10-mile loop. We had to do it 5 times. And I sat there, and all those demons crept in, right? Same thing with trading. You don't belong out here. No one cares that you're out here. What are you doing? You're never going to finish this. You're not good enough. And you have to make the conscious decision. And there was so much ahead of me, like 20 more miles ahead, right? You have to make the conscious decision to say, I'll die out here, literally die out here, before I don't finish this race. I'll be the last person in. It was taking me way longer than I wanted to, way longer. But if you make that conscious decision and you just step back up out of the chair that I was sitting in and start walking your ass towards the finish line, you'll hit the finish line. That's me in the dark. I started the race at 7 a.m. Just remember that no matter what, if you keep putting one foot in front of the other in trading, no matter how hard it gets, no matter how many, accounts are blown and mistakes are made, it's not, to be the degen and run yourself into the ground. If you tell yourself, I'm going to do this, and I don't leave myself any option but to do it, you will do it. Period. End of story. Conquering your fears. This is kind of another similar one. This is me diving with bull sharks in Jupiter, Florida. I was horribly afraid of the open water. My wife was scuba certified, and she got me first my scuba certification for my birthday, and I made a whole bunch of excuses. I pretended I was sick one time, and we rescheduled it. It's a true story. Because I just didn't want to go. And eventually I did that, and then for another birthday, I think she's trying to, off me, she goes, we're going to go shark diving. So this is Jupiter, Florida. That's a bull shark that I'm next to, the most aggressive shark species. And I was horrified when we were going. She was scared as all hell. Why we do these things, I think, is to prove to yourself that you can do whatever is the hardest thing for you. You can do it, right? I didn't want to, and if I looked back on this, even right before I did it, I'd say not for $1 million am I getting in the water with the sharks. I'm not jumping into where all the sharks are in the water. That's crazy. You can do whatever you set your mind to. You have an unlimited capacity to grow and to do whatever the scariest thing in the world is. You can do that. I'm proof of it. Horrified, right? All of you can do that, and everything else that I've done. That's the mindset that I want you to take away from this, guys. Grit, conquering your fears, never giving up, and don't limit yourself. Don't limit yourself. believe in whatever it is with an arrogant confidence, right? Before you're able to become profitable, at a certain point, you really have to believe in yourself. Create all of the data. And if it's through back testing, if it's through tracking your data, being at conferences like this, reading all the psychology books, all of that is extremely important, right? You have to have an edge. You have to have an understanding of risk management, all of that. But at the end of the day, when it comes time to actually do the damn thing, if you don't believe in yourself, no matter if everybody else around you does, you won't do it. So remember that. Believe in yourself. Now, the fun part. Whoa. I'm going to skip through these pretty quick, guys. Quick show of hands. Who knows what win rate and risk to reward are? I know we got some new people in here. Throw your hand up, because if you don't, I'm going to have to take time to explain it. Okay. We understand what hit rate is. We understand what risk to reward is, right? The amount that you're risking versus the amount that you stand to gain. Simple examples up here. You guys can all get these slides. I see Steven taking a picture. You guys can all get these slides, but that's why I wanted to do it this way. You know what we're talking about. Let's jump right into it. There's a couple parts to this, but first, you guys might know where I'm leading with this. Show of hands for win rate being the most important metric. Who thinks a high win rate or win rate in general is more important than risk to reward? And again, it's cool. You're all going to be wrong. Don't worry. Cool. Awesome. Show of hands for risk to reward. Okay. I got like half the room raising their hand. Awesome. Awesome. You guys guessed it. You're all wrong. Neither. Why? We know this stuff, right? But we're going to build on this. They have to be viewed together. Win rate alone, you tell me you have a 90% win rate, you know that doesn't mean anything, right, guys? We understand that. If I have a 10-to-1 risk to reward, if I tell you that without a win rate, does that mean I'm profitable? Okay, we understand that. We're all on the same page. Great. They have to be viewed together. They give no indication by themselves at profitability or positive expectancy. Okay, we got there. Now, this is a little bit dark. Before we even ask which risk reward is best, who, when they first started or early in on their trading journey, was told that you needed to make more on your winning trades than you lose on your losing trades? You need to make 2 times or 3 times. Show of hands. Like you've heard that before, maybe. Okay, great. The entire room has their hands up if the camera can't see it. I love this stuff, man. It's great. Which risk reward do we think is best? Let's just do 2 of them on here. Show of hands for 1 to 3. Show of hands for 1 to 1. Okay, maybe like halfway split. The next one, you're all wrong again. There's no best, guys, and here's why. This is really the point of this entire presentation. It's been really pivotal in my trading, even to recently reflect on this. There's no inherent edge in risk to reward alone. Okay, I see Lawrence shaking his head. He likes this one. This is good. There's no edge in risk to reward alone. And I'm not talking about win rate not being spoken about with risk to reward. I'm talking about risk to reward alone. Let's get into that. Looking at these risk to rewards, which is a little bit dark, I hope you guys can see some of them, they all have a natural break-even win rate. We probably understand what this means, but the basics. If you are trading a 1-to-1, in order to make money, you need to be over the break-even win rate. If you're risking $100 to make $100 and you're winning and losing exactly half, you're breaking even, right? We have to increase past this break-even win rate for all of these risk rewards. But here's the example that is really important to understand with this stuff. In random market conditions, which we technically do not have, but completely random market conditions, with no edge whatsoever, entering randomly, and nothing that would erode our P&L like spreads, commissions, fees, swaps if we were trading Forex, anything else, we would end up breaking even at the natural break-even win rate for any risk to reward that's on that board. Does everybody understand that? Let's take a look at both of them again. This is actually going forward. In random market conditions, if we entered randomly, flipping a coin, right, with a 1-to-3 or 3-to-1, right, making 3 times what we're risking, we'd end up not making or losing money. We would just have a 25% win rate. The same is true for a negative risk to reward. If you risked $100 to make $50, you would end up break even with a nice high win rate. Why do I think this is so important to reflect on and really understand? I'm sure a lot of you guys are more advanced, you understand some of this. We are often holding on to this belief that we need to make our winners larger than our losers. We need to hold on to these winning trades. There's unique benefits and drawbacks to each of these, which we're going to discuss briefly after we get through expectancy. But I believe so many traders are held back by this belief that they need to have these massively outsized wins, which will inevitably be a low or negative, what we call a negative win rate, and really create a difficult to trade system, right? Now, you might be the Lawrence and really enjoy a high win rate, low risk reward system. We're going to talk about what that means, but I need you guys to know that you don't have to have a very high R multiple and a high or a low R multiple. Find what works for you in your strategy and you personally. Okay, we're going to talk about the differences here, again, both on the practical side and then just a little bit of my opinion, as well as kind of the unique differences. But this, I think, is one of the most simple but misunderstood concepts by beginner traders. It's something that I held on to for years. And if you asked me this 3 years ago, I'd say, yeah, no, higher risk reward is better. You need to make more money on your winning trades. That's how you make money trading. And then if somebody asked, well, don't you just need to increase past the natural break-even win rate for whatever risk reward you would have? I'd say, I don't know what that means, man, but I'm just going to keep on trading. Hold your winners, man. So as we get into it, we're going to talk expectancy just real quick. I'm going to breeze through it just so we can talk about some of the differences here. You guys still with me on this? We're following? Does everybody understand what we're talking about on here? Because I know I'm getting like technical on it after that beginning piece, but we understand what I'm stating here, right? You guys grasping this? Okay, cool. All right, we're going to talk expectancy real quick just because I didn't think it would be appropriate to do this presentation and not talk about the combination that brings risk to reward and win rate together. So real quick, expectancy is the average amount that you can expect to make or lose per trade over the long run. I don't love this metric, but I think it'd be helpful if you're comparing different risk to reward combinations. We can very simply say we need to just get past that natural break-even win rate, right? If we're running a 1-to-1, we know we'll be profitable with a 70% win rate, right? If we're running a 1-to-3, for example, we know the natural break-even win rate is 25%. If we're at 40%, we're nice and profitable. But if you really want to get into the nitty-gritty and understand what that expectancy for that specific combination would be, expectancy is going to be the formula. It also is going to help you compare the difference between increasing past the natural break-even win rate with a low R multiple versus a high R multiple, which is a little bit different. And there's a case to be made. One's better than the other there, but it's important to recognize there's no edge in it alone, guys. Just continuing through a little example on it. Again, I'm going to breeze through this stuff. I don't think we need to do math here at the end of the day. I'll give you guys the slides. You guys can pay attention to it. But just explaining what the expectancy would look like for a 1.5-to-1 with a 60% win rate, how to calculate it, and what that means for you. Positive expectancy at the end of the day is going to indicate a profitable system. A larger expectancy, if you are comparing like risking $100 per trade with different win rate and risk reward multiples, ratios, you'd be able to compare them side by side, kind of see what that looks like. But here's really what I want to talk about. The differences in win rate and risk reward combination. So we know there's no edge in it alone. We know we're faced with the same challenge of increasing past that natural break-even win rate. But we might say, well, what does that look like for me? What does that look like if I'm trading a higher risk to reward, lower win rate, which is natural, or a lower risk to reward, closer to a 1-to-1, like you've heard a lot of these guys talk about today, and maybe a higher win rate, right? Austin's talking about being around a 1-to-1 with a 70%. One is not necessarily better than the other. I'm going to talk about one piece with expectancy. It's a little bit important to recognize. But they create drastically different distributions in equity and in the distributions of wins and losses that you will see. So this is somewhat obvious, but it's important to recognize as you guys are kind of crafting this for yourself, looking at your averages and deciding how you want to structure your trades. Higher risk to reward, lower win rate systems can be very profitable, but inherently you will deal with significantly more losses, oftentimes losing more trades quantity-wise than you win and having longer losing streaks, okay? Opposite is true for higher win rate systems. You will win more frequently. You will go on winning streaks as opposed to those losing streaks. I feel, and again, here's where I'm adding some of my, my opinion here. I feel a lot of traders struggle with confidence because they are attempting to trade high risk to reward, low win rate systems. It becomes very, very difficult to continue trading after 3, 4, 5 consecutive losses. And even with a modestly low win rate, I'm going to give you the example, you will have to withstand a number of consecutive losses in a 50 trade sample size. I'm going to look at you for this one, Lawrence, for sure. I'm going to try to get the numbers right. With a 40% win rate, you're near the 90% mark. I think you're over the 90% mark to see 5 consecutive losses over every 50 trade sample size. So doing everything correct, naturally, with a random distribution of wins and losses, you will incur a 5 consecutive losing trade streak. I want you to think about what that looks like, right? Maybe you're taking 1 to 2 trades, per day. That could be an entire week of losses. If you're trading with a 30% win rate, that number continues to go up, okay? Again, they can be extremely profitable, but I think it's really important to reflect on. And if you choose to go that route, which is totally fine, there's a ton of high risk-reward traders, you have to really reflect on what that distribution of wins and losses will look like for you doing everything correct with your system. Higher win rate systems and a more modest risk reward. I'm not talking about a negative risk reward here. Maybe we're closer to that 1-to-1, 1-to-2, with closer to that 55, 60% win rate, something modest in the middle there. You won't have to withstand those losing streaks. You'll go on more winning streaks. You'll be able to build some of that confidence and actually be able to trade the damn system in front of you before you strategy hop, change something up. Again, I think this is really, really important for men and women that are early in their trading journey. Continuing down this path. Questions, guys, and feel free, hop in. Anything in between here. Lawrence, comments, give it to me, man. Yeah, no, it's a great question. So I think number one, most traders have this, they're misinterpreting it. Even if they understand the basic stuff that I'm talking about here, and I hope you guys do, and I'm happy to answer questions on it, I don't think they really recognize the high probability of the losing streaks that they're going to see with a low win rate system. And if you're trading something with a 2-3 to 1 on average, you're more than likely not going to be at 50%. I mean, we have stats from a lot of traders. I don't love the top step board because I think it gets a little bit skewed. But you could look at some of these numbers, and if you're over a 2 to 1, you're almost never at 50%. And if you're under a 50% win rate, you're going to lose more frequently than you win. You really have to be ready to take those losses, and I think they can be difficult. I think it can be really difficult. So either adjusting by deciding to widen out a little bit, get more modest on, widen out stop loss and maybe bring in, take profit a little bit, get more modest, increase that win rate. But past that, it would really just be acceptance of your system. How do you know what your risk reward is, what your win rate is? Again, if we're not trading with let's just look at it again. If we're not trading with a fixed risk reward, right, which most of us are not, we're not entering and exiting the market with one contract size with a fixed take profit and fixed stop loss, you're going to have an average, right? Maybe you look at your account metrics on whatever firm you're trading with. You're going to have an average. That's your average risk reward and win rate. And from that, you can create an understanding of what the equity curve is going to look like, right? And I think that in itself is important to reflect on. It's a Mark Douglas quote. I'm going to see if I can hit it right. There's a random distribution of wins and losses for any given set of variables that define an edge. Okay, it's a great one. Mark Douglas, Trading the Zone. Rest in peace, Mark Douglas. Love that book. I've listened to it on tape while I'm running ultra marathons like 100 times. Not 100, probably like 6. Think about that quote again, though. There's a random distribution between wins and losses for any given set of variables that define an edge. Reflect on that. When you flip a quarter, does it land heads, tails, heads, tails, heads, tails with a 50% win rate? No. It lands heads, 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 tails, 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 heads, 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 heads. That means you're going to see negative and positive variance. And if you're running a system with a 50, 40% win rate, and again, this is even for modest win rates, guys, you're going to see a lot of losses. You're going to have to recognize that, and it's a random distribution. It's not an even spread. So, you have to build confidence in your system if you're not going to backtest through forward testing with low risk. And again, creating that belief in yourself and understanding of the game of probabilities that we're playing to be able to trade through the losing streaks. I think a lot of traders are, one, misinterpreting some of this stuff, but two, just really not recognizing what this means and what this will look like over the next 50 trade sample size. And they may have a great read of the market, great way to manage risk, a great edge, but they never let it play out. because as soon as they take 2 or 3 losses, doing everything they're supposed to do, and they actually needed to take a 4th, they never get to the 5th and 6th trade that bring them back to profitability into a payout. So think about that, guys. There's a lot of losing in this game, a lot. And it's a game of probabilities that we're playing. You can adjust this stuff. You can decide to tone back on risk to reward. You can decide to increase it, and that will adjust your win rate naturally. So I think by understanding some of this stuff, it opens you up to a lot of freedom and flexibility. Don't be pigeonholed to think you have to have some high win rate or high risk to reward number. You don't. You have to create a positive expectancy. You have to increase past the natural break-even win rate and understand what your combination means for you. So just a little bit more on this, and I'm happy to take some questions. High risk to reward, low win rate strategy. What does that equity curve usually look like? And Lawrence might be able to speak on this. Oftentimes, a lot of flat periods and then sharp stair-step type movements. It oftentimes requires a larger sample size to be able to evaluate it effectively. Otherwise, you might take 3 or 4 trades right off the rip and they're losses. You might have a great strategy, right? But if you don't actually give that thing time to play out, you never really get to realize that. Opposite is true for low risk to reward, high win rate. They appear reliable right off the bat, right? So if I give you a half to 1, I say you only got to make $50, 5 points for risking 10. Probably be able to hit that pretty quick, but you got to recognize you also have to allow that to play out over a large sample size. As well, can be more fragile. Here's where we kind of get into some of the differences here. Quick, and they're also just more susceptible to errors. Multiple losses can really start to disrupt that overall growth if you're running a negative risk to reward, right, as opposed to the real high risk to reward. I think on the next slide I got some more on this. Psychological differences, which we really want to get into, but I'm going to start on the bottom here. High risk to reward and low win rate systems. This is more of the math, and important to recognize because I'm sure you guys will do the math and call me up and say, no, I think you're wrong. So I got a ton of YouTube comments on it. I love having this conversation. With a high risk to reward, low win rate system, you will have a sharper increase, a more drastic increase in expectancy as you increase win rate past that natural break-even win rate. And the opposite is true for lower risk to reward, higher win rate systems. That can be seen as an advantage to say, I don't need to increase as much in win rate past the natural break-even win rate because I have this high R multiple. But what you also have to recognize is that's a double-edged sword, because if your win rate starts to drop off, that expectancy is more volatile with the high risk to reward system, and you run the risk of ruin a lot quicker if you run that win rate down quite a bit. But that's a really important math part of this to understand. From a psychological point, it's a lot of what we were just talking about. A lot of patience required for the high risk to reward stuff, guys. A lot. You have to be able to withstand losing a lot of losses. We have to lose a lot in this game as it is. If you set yourself up with a 25, 30% win rate, it requires an enormous amount of confidence in your system and belief in yourself that a lot of traders just don't have early on. And it can be very, very difficult to get through. I'm a fan. Obviously, you kind of hear the way that I'm biased talking about this. I'm a fan of a more modest risk to reward, modest win rate. Something more down the middle, preferably right around that 1-to-1 and positive on the win rate. I believe, again, it allows you to build more confidence. It turns those losing streaks into winning streaks. It can be, quote unquote, easier to trade that day in and day out and stack up green days on prop accounts specifically. But lower tolerance for errors, right? With a high risk to reward system, if you take a quick L, if you have to take a quick haircut like Tanner did this morning, it's not as drastic, right? If I'm running a 0.7 to 1 and I enter on tilt, I do something crazy, that one loss is going to weigh. It's going to be weighted into that equation heavier. So again, double-edged sword with this stuff. Questions on any of this stuff, guys? Questions? Thoughts? So you said higher RR first, but lower RR first. That was it. I do. And again, there's going to be multiple schools of thought, right? So this is now my opinion. I want to kind of differentiate between what I would say is just the simple math behind it and now my opinion. I think if most traders just started with a 1-to-1 and around a 50% win rate, and we tried to win maybe just a little bit more than we lost, like a 1.1, 1.2, by allowing those trades to run, and maybe win a little bit more quantity, rather than running at the extreme version with a real high risk to reward or low risk to reward, we would do much better. So yes, I think as a whole, again, markets are not completely random. We have other things to consider that we have to cover, fees and spreads. But we're playing a 50-50 game off the rip here, guys, if you think to really dumb this stuff down. And most traders' equity curves are a straight shot to the ground, right? And that's for more reasons than just the math behind this. But if we just started out trying to make a little bit more and win a little bit more, rather than some crazy expectation of having the confidence to trade a 20% win rate, 5 risk to reward system, yes, we would be much better off. And I think as you grow as a trader, you'll naturally find, based on your strategy and approach, right? You know, trend following systems may provide much larger movements. It may make sense to attempt to capture a whole lot more of that move. Reversion trades that, you know, we saw some guys trading here, they may provide these really cheap setups where you are going to take multiple haircuts, run this low win rate, high risk to reward when it finally hits. But I think off the bat that can be difficult. It can be really difficult to handle. And again, opposite is true. Same is true for the extreme, right? I think a negative risk to reward system, what I would refer to as a negative risk to reward system, where you are standing to lose more than you make by a lot, can be very difficult. Very difficult to trade. Requires a lot of accuracy, and while it can seem like you're a godlike trader right off the bat because you don't need the market to move in your direction very quickly, a couple losses can be really, really tough to stomach and tough on the P&L. So, did I answer the question? Awesome. Questions, thoughts, concerns? Let's get there. Come on, PowerPoint. There we go. Yeah, go ahead. Mm-hmm. Yeah. Yeah. We'll pull it up. I meant to put it on this, but it's a simple chart. I'll include that for you guys. Mm-hmm. Mm-hmm. Changing the sample size to get a percent probability? Yeah. Yeah, that 50 trade sample size. No, I understand. I don't think it's as important to, because I'm not utilizing that data in some super specific way outside of interpreting the difference between, you know, a one win rate over another, because that's specific to win rate. So I think a 50 trade sample size is a pretty decent, you know, chart to look at, and it will give you that understanding of the probability of seeing it. But if you wanted to get an exact number, there's math behind it where you can do it simply. So yeah. Mm-hmm. 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 Sure. Mm. Mm-hmm. Yeah, yeah, it's one way to do it. I would probably just lean on the high end of, because you're doing it for like risk of ruin, right? Like for risk of blowing the account, like right for just full account sizing. I'd be way more conservative than that. Yeah. So this is more advanced position sizing strategy, which is a good way to do it. It's an interesting way to do it. I don't know that I would use that chart in that specific way, and I don't know that I would look at a very small sample size, because I do think it requires a fair sample size to get an idea. So yeah, it's an interesting way to go about it. Interesting way to go about it. Yeah, yeah. We can talk about it after in a little bit more detail. Yeah. More questions, guys, 'cause I'm going to get to the end of this right here. The key takeaways here. Neither win rate or risk reward is more important. One's not more important than the other. There's no edge in risk reward alone. And again, if you leave with anything, I want you to reflect on that. A high R multiple is not going to save you. A high win rate is not going to save you. You don't have to have an ego in one of those or another, and there's going to be a combination that's best for you. And if you allow yourself the freedom and flexibility to review your averages here and experiment with, again, maybe a lower R multiple, higher win rate, because I feel most traders are dead set on trying to get a 2 or a 3 to 1 out of their trades for some reason, you can open yourself up to more profitability, to more expectancy. Different combinations have unique benefits and drawbacks. We talked about some of that. Do the expectancy calculation. Look at your averages, do the expectancy calculation, and then play with it. What would it look like if I had a higher R multiple and I kept my win rate the same? What would it look like if I increased my win rate, but I kept my R multiple the same? Adjust from there. Experiment. Understand the relationship between risk to reward and create a positive expectancy. Find the balance. Find the balance for you, your personality, your strategy, your approach. That's what I got for you guys. And guys, thank you. No, I appreciate you. If you guys have questions after this, I'm happy to be here. I'm happy to show you my charts, talk about any of this stuff in detail. I do majority of what I do for free. More than happy to have you on my live sessions, 9:30 a.m., and in my free Discord. It's not a VIP feeder program, anything like that. Hope to see you guys there.
One more time, everybody. The new look, Mr. Boyajian.